our economy's strength by supporting maximum employment and returning inflation to our 2% goal.
By the way, we were correct about the 25 basis point cut.
The FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. Were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down.
Yo, chat, is the audio good? I think I asked like 5 times. Just put a 1 in the chat and just let me know if it's good. So I don't know. We're not running this for like half an hour and there's no audio.
It's narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate.
He's not saying nothing, but I can't wait for the Q&A here. Trump's back, baby.
By 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive
And just so you guys see here, they are expecting another rate cut in December.
administration?
63% likelihood of a
Sure.
rate cut.
So let me say that, as you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate. Could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timrose from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher US Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
You get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
NIPA is basically it's like the Bureau of Labor Statistics. It's the National Association representing retirement and retirement and employment benefits. So Bureau of Labor Statistics is mostly just about active workers. This is more about retirement statistics for government and other economists.
Remember, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you develop of detail as to why?
You know, we don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I would just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? You know that we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September and in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. You know, we're just going to have to see where the data lead us. We have, you know, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but you know, I would say, you know, I would say that, you know, again, we didn't update the SEP, so I'm not going to characterize, you know, where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we net that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. You know, there's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates? And are rising deficits a concern to you?
So we don't comment on fiscal policy. And again, I don't have a lot more to say on what's driving bond yields. In terms of of policy changes, though. Let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outlines, so we'd start to model it, and then we'd wait, and then at a certain point, the staff would brief the FOMC and say, you know, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we try to get smart on that, and then the law actually passes.
Basically, it's going to stimulate the shit out of the economy because corporate tax rates is only ever stimulative. Now, from the trading side, pretty like okay, I'm a little okay. So if I draw from the 15-minute body, we already hit the 88.6. If we draw it from the 5-minute body, go down one time frame, we see the true body is a little bit lower, about 50 points lower, which would mean that we have not hit the 88.6 yet. This was a false flag. And so the move, either way, there's no entry because the entry would have been down here. So I'm just hoping that we get a retest back to 21,060 so that we can enter these longs and keep this momentum going.
Time and that we go through all the time with every administration constantly. And this will be no different. But, you know, right now there's nothing to model right now. It's such an early stage. We don't know what sense of, you know, when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions only to find, you know, 3 weeks later the 10-year was 50 basis points lower. So, you know, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, you know, we're watching it, we're reading, you know, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Yes.
Whoa.
Revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop?
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But of course, our mandate is maximum employment and price stability. And we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago. And we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress. And today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market, even as.
This is just like watching a Kamala speech. He's just literally reading off the what's it called, the binder that he has. He's like, we will look at the data and make a decision as we look at the data. Well, come on.
Lead you to that path.
You're on the way out, bro. He's very likely on the way out. Like, bro, just let it loose.
Made any decision like that at all, but we're in the process, as I mentioned.
I think he's a little bit somber about the Trump victory. Let's not forget that he is technically registered as a Democrat. So is Janet Yellen, both very good friends with Biden. They're not too happy, but Jerome Powell was appointed by Donald Trump.
So, for example, if we were to see the labor market deteriorate.
And Chartaddicts members, look at the 17 extension rejection right here. I should have drawn it from the 15-minute low. that would have been a perfect rejection straight to TP 1, 2, 3, and now 4. So let's see if we get this retracement back down and enter again.
Possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
The question I've been waiting for.
So I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But
Why are you tripping over duration risk when the bond market is telling you that you don't need to cut rates?
3%. So we look at all of them, and we look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, unsustainably low.
Members, we might either get a Model 1 continuation here. So it's probably going to be below the halfway mark, just kind of come back into the 61, somewhere around here in this area. Or ideally, if we can get like a full retest, we can just get in TP1, TP2, and jump out. This thing could crash all the way through, but I'm still expecting some kind of rejection here, at least at the TP1 or TP2 could be a good opportunity to take a trade. Little risky, Fed meeting, high impact news. You guys get the drill. Make sure that you're following your plans and you understand how confident you are and how experienced you are in the markets or in trading before you just jump in today. If you're not that experienced, you're not that confident trading high impact news, don't even, why, right? Don't even bother taking a trade. Follow your plans. Risk management is key.
This time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back at that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent.
Yeah, if you were going to go get a brand new rental today, it's way higher than if you had gone it 2-3 years ago. But if you already have an existing rental, your incremental price that you're paying, like every year your rent goes up, that's not going up as much as the new renters are having to pay. Does that make sense? So it's worse for new renters than it is for existing renters.
About inflation. You see that catch-up inflation also in insurance and several other areas. So you're seeing, we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be 1 or 2 really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there.
There we
We're
go.
seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find.
And by the way, just side note, I think this is a perfect framing for the Fed, which is we're not doing this as a reaction to anything, which is why we're doing it so slow. This is a natural process where if we're going to get back down to the neutral rate, which at this point, they don't even know what it is. They're just picking a number out of the thin air of what the Fed funds rate should be. But they're not in a rush to get it back down there to where they're going to cause these big market fluctuations. That's bullish. Not because it's fundamentally or macroeconomically bullish, because it's going to lead to a ton of money flow. It's bullish because asset managers and capital allocators need predictability. If you know what the next 6 to 8 months are going to look like, you can invest in anything, right? If the stock market's going to crash, then you can just put it somewhere else, but you need clarity as to what the road looks like and set expectations that the Fed will stick to. And so I think that this new era where the Fed is not flip-flopping all the time, where we don't have these impending issues and emergencies we have to constantly deal with, I think this will allow things to normalize slightly and then naturally fix themselves. Not fix it all the way, but at least get out of the emergency mode. If the Fed keeps trying to interject and they keep trying to put their hand into that invisible hand, then we're going to keep running into the same problem, because all the problems we are dealing with now are a function of the Fed's policies, starting in the dot-com bubble, even before, and then especially since 08.
Relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's come down significantly, moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool. To be in a good place, and our policy, of course, is designed to maintain the strength in the labor market while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you could say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. But we don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria. Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data. But in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much of a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global
Walter, what you talking about?
is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of.
If you guys are watching this on YouTube, please make sure to drop a like and subscribe because YouTube wants to hide these streams because I talk shit about them all the time, but I love YouTube so much, guys. Make sure to click like and subscribe.
Caution and things like that, but ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were.
Also, stick around to the end. I'm going to be giving away a few free tickets to the FX Summit conference here. Some people that answer a few questions, nothing too complicated. Just a few general questions, and we'll kind of summarize everything that Jerome Powell just said. It's not much, okay, but we'll summarize it here in a sec.
That can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've heard this from several people that next year could even be stronger than this year.
Andrew.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay.
Except for those backroom dinners with Janet Yellen.
To follow up on,
we're friends and we hang out and go to the same dinner parties, but we have no influence at all. We never even talk about it. Just honestly, I don't even know her.
President demoting at will any of the other governors with leadership positions.
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney.
Damn.
Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail?
Good question. Except for that last part where she tried to give her political answers.
At all, nor will I today. So what I'm just saying is, as we look ahead, we know, as I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk, and that to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that
oh
we
my
allow
God,
the labor market to weaken too much. And
but this is like listening to Kamala Harris. It's like, yeah, I mean, look, the risk is it could be too hot, but then on the other side, there's another risk. And that risk is that it could be too cold,
We're in the middle.
Wow.
We try to be in the middle and deal with manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive, but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing we're meeting by meeting, we're going to be making our assessment of what the right path is.
He's just bullshitting her. What she really should have asked is, if you are so uncertain about these conditions in the future, how could you be so sure that we should continue to cut rates in an environment where we haven't really tackled inflation completely? If you're so unsure about the future, why are you making these big consequential decisions as if you know? And I know that they're trying to move slowly, and that's why I think this neutral tone is perfect, and he's sticking to the policy of the next year and a half of slowly getting it down. Perfect. But you can't also claim the economic uncertainty part, because you're making a very consequential decision that you seem to be pretty sure of.
Chair
here.
Powell, Simon Erminovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's kind of right where it's been. And also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But
how? If prices have not come down yet, after we've already technically tackled inflation, how are they supposed to come back down? You can have as many supply chain deals as possible, bring down the cost of production, bring manufacturing, offshore to reduce the supply chain costs. You're still not going to get back to where we were. So I really don't understand where this disinflation is supposed to come from. I mean, maybe you guys can enlighten me.
Many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example.
Give her a raise.
And the world went through a global inflation shock. And inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is, it takes some years of real wage gains for people to feel better, and that's what we're trying to create. And I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people, regain their confidence and feel that. And, we don't tell people.
Yeah. When's Inauguration Day? January 20th. That's when people should start to expect to feel it. Okay. Plain and simple. Open up American manufacturing, open up American production of oil, reduce the price of gas, which is one of the largest kind of variable costs in the budget, open up supply chains with some of our closest partners to bring food prices back down. And I think that's all going to happen before he's even in office. So it's not a Fed policy thing it's not a Fed policy decision that's going to lead to wage inflation and make sure our people are getting paid more in this country. It's going to be a decision of this administration to either open American production and American progress, or to continue to stifle it by printing money, getting us in debt, and giving out handouts.
It's of course a very difficult thing, because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied.
I'm going to disprove this with 2 charts real quick. You guys ready? Watch this.
On wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to to move gradually down towards neutral, that the economy will continue to grow at a healthy clip and that the labor market will remain strong. If you look at our that will not change from the September SEP. You know, that is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So, but ultimately, you know, we're not in a war where we can afford to rule things out.
Okay, so let's take a look at this. So this is the lows of the unemployment rate of this last administration was around 3.4%. And then over here, you can see like a year ago was at 3.7. We've jumped from 3.7 up to 4.3% unemployment. Okay, now we've come back down a little bit, but he said that we haven't seen a meaningful change in the unemployment, and we have seen while we've seen CPI come down. That's not true. And then we've also seen the labor force participation start to get affected by immigration and some other factors where the labor force is growing, but the amount of Americans who are registered under the census who are occupying those jobs is not growing. So that could be a contributing factor there to the unemployment. But I do think that there's a lot of missing pieces here that can be explained by something like the JOLTS jobs reports or the quits rate to give us a more detail. But just looking at this alone kind of disproves what Jerome Powell is saying. It's like, clearly we almost hit a recession here because of these high interest rates. And it's a contributing factor to why you're cutting them. He can just say that straight up. Okay, so Fed meeting is done. Thank you guys for sticking to the end. Let's give away 2 free tickets. Let me ask some questions here. What did Jerome Powell say? You don't have to do the exact quote, but just in general, what did he say about what they expect to do in the next meeting? And it's very similar to what they say every time. But what's Jerome Powell's go-to phrase when they ask him what they're going to do in the next meeting or if they're planning on cutting or whatever? What did he say? Whoever answers this gets a free general admission ticket to the FX Summit. If your answers are pretty close, you know, within like a couple seconds of each other, whatever it is, who knows? We're feeling generous, might give out a few extra tickets. What financial resource do I use for fundamental analysis? We have a fundamentals course on the website that gives you all of the resources that I use. If you're paying attention to your screen, which hopefully you are because you're asking this question, then you should have just literally looked at the website I was using to show you this proof and answered your own question. Because guys, I'm going to tell you this, all right? Because I kind of got off the path of being honest with everybody on YouTube, and that's kind of whack. So I'm here to be honest with you guys. If you can't use your eyes to look at the screen and look at what I'm doing and realize, oh shit, I don't know if Roy meant to pull out the St. Louis Fed website and show us the real sauce, but like, I'm going to write that down real quick because that's clearly, you know, a website that he's using for his analysis. And he's doing this in front of hundreds of people on YouTube and potentially thousands that will watch this. And his reputation's on the line. So he's not going to pull out some random website. So that's something you would write down, right? Now, if you don't even have that much foresight, I would just stay away from all financial data because it's just going to run you into a fucking wall. All right. This is just me being 100% honest. People used to be on these live streams and they'll say, Roy, where's your entry for this trade? And the chart, it's right in front of them. And I used to tell people, I'm like, dude, if you don't have the observational skills to look right in front of you or have enough deductive reasoning, then how you expect to trade? All right. So let this be a kind of a wake up call. All right. Ask your classmates before you ask the teacher. To summarize what Jerome Powell said, I'm going to wait for the answer to this question first. Look at the data before making a decision. We need to perform our dual mandate. Sentry, send us your email. Send me an email to info@chartaddictsfx.com. info@chartaddictsfx.com. Say, I was on the YouTube stream. I answered the question correctly. My name is, and then we'll be able to get you the information you need. Good stuff. He said, we're going to look at the data and then we'll make a decision. And we still have to stick to our dual mandate. So very straightforward. We will see the results in the following weeks. Yeah, he will. Anybody else notice kind of the shift in his mood? I genuinely feel like this Trump presidency kind of marks the end of an era here. Truth be told, Jerome Powell was already on the way out before Joe Biden pulled up. And then Joe Biden, once you get a call from the president and said, hey, how'd you like to serve your country? It's not exactly a question you say no to. You can't even say no. Like, it's not, they're not really asking. So Jerome Powell got thrown right back into the wolves' den. And he's, you know, trying to stay as impartial as possible. I highly doubt that Jerome Powell wants another 4 years dealing with a Trump presidency, where he has to explain every single time that he has no control over tariffs, he has no control over the mandates of the presidency or the executive branch, and all he can control is the interest rates and control the money supply and basically just impact those dual mandates of maximum employment and price stability. Okay. The Sultan of Pips, that's correct. He said data dependent. All right, Laugh Lounge, I'll give it to you. But I mean, you said two, like, you know what I'm saying? They said a whole sentence. Laugh Lounge, or if you're actually going to come to the summit and you're actually serious, send us an email. We'll get you that free ticket. These tickets are not resellable. You for some of y'all, okay? Cool. Mr. Investment, your name is Mr. Investment. Okay, Lord have mercy. Roy, would you mind pulling a fib on oil shorts? Truth be told, nah. I mean, no, truth be told, yeah, I do mind. Not gonna be giving away free analysis anymore. Like, I'll do it sometimes, obviously, but I started to realize nobody values my analysis because I'm literally just giving it away for free all the time. And it's like after that Bitcoin sort of prediction from April to now, being as accurate on like 4 or 5 different points, all the trades that you guys can see on Twitter. If you go to our Twitter and you see the pinned post, you can see every live stream trade that I've taken, every live stream call out before and after on YouTube, directly calling it live in front of everyone. So yeah, if you guys want analysis, join Chartaddicts, become a member, hit me up in the group chat and ask, and then I'll always make time for the squad. If you guys have a question for me in the VIP members chat, let me know. Always just tag me up. Make sure to get you guys what you need. All right, y'all. Happy safe trading. We'll check back in with you guys soon. Make sure to grab your tickets to the FX Summit 2024 conference. Use promo code Chartaddicts to get 50% off all tickets. And if you guys get a VIP ticket, you get to come and hang out with me and all the speakers. Every single last one of them come hang out with us at these private events. And that's worth an unlimited amount of money. Okay, we'll see you guys there. 50% off VIP is an absolute steal. See you guys in Dubai. I can't come to the summit anymore. Can I give my ticket away? Chris, message us in the email, not info@FX Summit. Message us at info@chartaddictsfx.com. Let's see what we can do for you. We'll see if somebody else can take the ticket off your hands. And so that way you're not just, left sitting out. Mr. Investment asks, what fundamentals do you use? I use, which one? I look at CD. Mr. Investment, you heard of CD? We have the Fed, St. Louis, but have you heard of CD, Mr. Investment? So we have the St. Louis Fed and then the the Bureau of Labor Statistics, but specifically, have you heard of CD? That's one of the biggest ones. Number one. Said, is that a resource? He said, never heard of it. Yeah, CD's nuts in your face, boy. Fucking get the fucking.